diplomacy channels, much like the Strait of Hormuz, are blocked. Iran is charging ships a toll in four currencies: the Chinese yuan, stablecoins pegged to the dollar, and Bitcoin. And the SEC commissioner who spent years dissenting from inside the agency just watched her own safe harbor proposal become official policy. In this episode, we're exploring three intersectional stories: the geopolitics of money, the infrastructure adoption, and the architecture of U.S. crypto regulation. They're all colliding in real time. If you've ever wondered whether crypto is ready for the real world just showed up at crypto's front door. I'm Dr. Tonya M. Evans, and this is Confidently Crypto. Welcome to Confidently Crypto. I'm your host, Dr. Tonya M. Evans, digital asset regulatory strategist, CEO of Advantage Evans Global Regulatory Strategies, board member at Digital Currency Group, law professor, and author of Digital Money Demystified and Electing Crypto, both available at digitalmoneydemystified.com. Now, this show exists to help you, whether you're crypto curious, a skeptic, an investor, a legal or financial professional, or just someone who knows this technology matters but doesn't quite know where to start. Navigate the digital asset economy with clarity and confidence. No hype, no jargon, just the real story. And today's episode is really special. I sat down with SEC Commissioner Hester Peirce for a wide-ranging conversation about the SEC's shift from enforcement to rulemaking, a 5-part token taxonomy, the 2% haircut framework, sandboxes, cross-agency collabs with the CFTC, and her advice for both law students and mid-career lawyers. So you're really going to want to stay for the whole thing. But first, let me bring you up to speed. Here's your state of crypto. So here are the 5 stories you need to understand right now. Story number 1, the Strait of Hormuz just became a crypto case study, and today it became a full-blown international crisis. I covered this breaking story in a recent Forbes.com article. The link is on my homepage at proftanyaevans.com. And on Sunday, April 12th, the story escalated dramatically. Peace talks between the United States and Iran collapsed in Islamabad overnight. Vice President Vance left Pakistan, saying the two sides could not reach an agreement, primarily over Iran's refusal to abandon its nuclear ambitions. President Trump announced that the U.S. Navy will now begin blockading any and all ships trying to enter or leave the Strait of Hormuz, effective immediately. CENTCOM confirmed the blockade of all maritime traffic entering and exiting Iran beginning CENTCOM confirmed the blockade of all maritime traffic entering and exiting Iranian ports beginning Monday at 10 a.m. Eastern, and the Department of Justice announced it will vigorously prosecute anyone who buys or sells sanctioned Iranian oil. Here's where this becomes a digital asset story. Iran's Islamic Revolutionary Guard Corps, or the IRGC, has been running what amounts to a toll booth operation in the Strait. Ships passing through have been charged up to $2 million equivalent per vessel, with payment accepted in the Chinese yuan, Bitcoin, and potentially USDT and USDC, both stablecoins pegged to the US dollar. Iran's parliament passed legislation specifying these fees and authorizing what they call digital currencies developed with Iranian company participation. So think about what this means for the regulatory frameworks we've been building here in the United States. The Genius Act was designed to regulate stablecoins, but its enforcement architecture depends on compelling issuers to comply. And Bitcoin, well, it has no issuer to compel. And this is the exact stress test that exposes the gap between the frameworks we've written and the reality of how decentralized assets actually move in the world. Chainalysis and TRM Labs both confirmed this past week while the toll system has been announced and ships have been charged, actual on chain evidence of Bitcoin payments at scale has not yet materialized, at least not as the date of this recording. TRM documented approximately $1 billion rooted through offshore exchange branded stablecoin infrastructure that's tied to the IRGC, and Coindesk reported a new wrinkle. The IRN, the Iran-backed Houthi, and Coindesk reported a new wrinkle. The Coindesk reported a new wrinkle. The Iran-backed Houthi regime, which already uses crypto to trade oil, has raised the prospect of imposing a second shipping toll choke point. Oh, Jesus. Go back to and Coindesk. 3, 2. And Coindesk reported a new wrinkle. The Iran-backed Houthi regime, which already uses crypto to trade oil, has raised the prospect of imposing a second shipping toll choke point in the Red Sea. So we may not be talking about one crypto toll booth. We actually may be talking about two. In my Forbes piece, it frames the Hormuz situation as a Genius Act stress test. With today's blockade announcement, the stakes just went up considerably. I'll share more as that develops. And if you're holding Bitcoin through all of this uncertainty, your custody setup matters more than ever. Whether you're using a hardware wallet like Ledger or SecuX, the principle is the same. Self-custody is how you maintain control when the world gets unpredictable. If you haven't already moved your long-term holdings to cold storage, now is absolutely the time. Links at proftanyaevans.com/partners. That's links at proftanyaevans.com/partners. That's proftanyaevans.com/partners. Next up, story number 2, Square just auto-enabled Bitcoin payments for 4 million merchants, and nobody's asking the right questions. So 2 weeks ago, Block, Jack Dorsey's company, flipped the switch. Square now automatically enables Bitcoin payments for eligible U.S. sellers. This is not opt-in. This is default on. 4 million merchants can now accept Bitcoin at checkout with instant conversion to U.S. dollars, no processing fees through the end of 2026, and no additional setup required. Transactions run on the Lightning Network for near instant settlement. Lightspark CEO David Marcus called it a potential TCP/IP moment for money. The infrastructure story is real. Merchants receive dollars, so there's no balance sheet crypto exposure. And merchants can even opt to retain a portion of their daily sales in Bitcoin. One analyst estimated that if even 5% choose to hold, you'd have 200,000 businesses adding Bitcoin to their balance sheets. But here's what nobody's covering and what I'm writing about for the hub.news. Not a single outlet in the coverage cycle addressed the merchant literacy gap. What happens when a micro business owner who's never touched crypto suddenly has it turned on by default? What about tax compliance under 1099 DA, the cost basis obligations, state level regulatory variation? New York merchants are excluded entirely, but what about the patchwork everywhere else? The coverage has been celebratory, but the question I keep coming back to is built, yes, but built for whom? The merchants who need the most education are the ones least likely to seek it out. And that gap is where the consumer protection story actually lives. If you're a lawyer or financial professional and your clients use Square, this is heading your way. Understanding the regulatory and tax implications of crypto payment infrastructure, it isn't optional. It's competency. It's competency. It's a competency issue. And that's exactly what we cover in the Web3 Ready Lawyer and Web3 Ready Professional Executive Cohorts trainings and the Beyond the Jade retake. And that's exactly what we cover in the Web3 Ready Lawyer and Professional and Law Student series at proftanyaevans.com retake. And that's exactly what we cover in the Web3 Ready Lawyer and Web3 Ready Professional Executive cohorts. I've also added a new one for law students, and you can get all of that information at proftanyaevans.com/beyond the JD. That's proftanyaevans.com beyond the JD. That's proftanyaevans.com/beyond the JD. Story number 3, Schwab just opened its crypto waitlist and the retail brokerage race is on. Now, this is a big one for everyday investors. Charles Schwab confirmed on April 3rd that it remains on track to launch. Charles Schwab confirmed on April 3rd that it remains on track to launch spot crypto trading in the first half of this year. The company has opened a wait list for its new Schwab crypto account, which will actually let clients buy and sell crypto, most specifically Bitcoin and Ethereum, directly alongside their traditional investments. CEO Rick Wurster says the rollout begins with internal testing for employees, followed by a small group of clients in Q2 before expanding more broadly. The service will run through Charles Schwab Premier Bank, and Schwab manages nearly $12 trillion in client assets across almost 39 million active accounts. That's not a typo, 12 trillion. Now, there are real limitations at launch. First of all, it's not available in New York or Louisiana. Also, there's no external crypto deposit, so you can't deposit. Second, there are no external crypto deposits. So you can't deposit crypto you have already onto the Schwab platform. There's also no self-custody withdrawals. So once you purchase on platform, you can't withdraw it to self-custody. There's no staking. There are no limit orders. But the significance, at least, isn't the feature set. It's really the signal. Because when a platform of this scale puts a join the waitlist button on its website for crypto trading, we have absolutely crossed a tipping point. Also, Morgan Stanley's E-Trade announced a similar H1 2026 timeline for Bitcoin, Ethereum, and Solana trading through a partnership with Zero Hash. Between Schwab and E-Trade alone, you're talking about tens of millions of traditional brokerage accounts. You're talking about tens. And between a Schwab and E-Trade alone, you're talking about tens of millions in traditional brokerage clients getting direct crypto access inside. Between Schwab and E-Trade alone, you're talking about tens of millions of traditional brokerage clients getting direct crypto access inside the accounts they already use for stocks and bonds. This is the institutional plumbing. That turns regulatory clarity into actual market participation. And that's why the work Commissioner Peirce and Chairman Atkins have done at the SEC, which you'll hear about in our interview, really matters beyond the policy world. Rules without rails don't move anything. And these are the rails. So definitely follow this story. Story number 4, the rest of the world is not waiting. So, three developments in the past 72 hours that tell you this is a global race. Hong Kong's Monetary Authority issued its first ever stablecoin licenses on April 10th to HSBC and Anchor Point Financial, a joint venture between Standard Chartered and Imoca Brands and Hong Kong Telecom. When HSBC is getting a stablecoin license, that's not a crypto story. It's actually a banking infrastructure story. Japan's cabinet approved a bill this week to reclassify crypto as financial instruments under the Financial Instruments and Exchange Act. Insider trading bans, issuer disclosure requirements, a kind of mature regulatory architecture that treats digital assets as real financial instruments and not just speculative novelties. And UBS, with five major Swiss banks, announced a partnership to test the Swiss franc denominated crypto stablecoin. The US has made real progress, but the competitive reality is that regulatory clarity has become a global race, and the jurisdictions that move first attract the capital, the talent, and the infrastructure. And finally, story number 5, markets. So Bitcoin is holding around $73,000 in extreme fear territory. Bitcoin is trading. Ethereum is retake. And finally, story number 5, the markets. Bitcoin is trading around $73,000 in extreme fear territory. Ethereum at approximately 2285. And the fear and greed index has been deep in extreme fear across the board, dropping into single digits earlier in April, a level that we've seen fewer than 20 times since the index launched in 2018. Historically, extreme fear readings have preceded positive returns over the following months, but I need to be clear that past performance never, in this instance, but I need to be clear, past performance does not predict future results, and the macro environment right now with active military conflict in the Strait of Hormuz and a global trade war is unlike anything we've seen during prior fear cycles. What I will say is this, that institutions aren't panicking. Schwab is launching, Morgan Stanley is launching, the smart money is building infrastructure while retail runs scared. And that divergence, institutions positioning while individuals sell, is exactly the dynamic I talk about in Digital Money Demystified. Volatility is information, not something to avoid, something to be managed and calibrated. If you want to learn more about that, grab your copy at digitalmoneydemystified.com. It's a great place to start to at least separate fact from fiction. And if you're an investor trying to make sense of all of this, track your portfolio. And if you're an investor trying to make sense of all of this, track your portfolio. Consider using Coin Tracker. It connects with your wallets and exchanges. It tracks your cost bases, flags taxable events, and gives you a consolidated view of where your assets are and what you owe. With the 1099 digital assets requirements coming into sharper focus, clean records aren't optional, they're essential. Visit the link at proftanyaevans.com/partners for more. So that's the landscape of geopolitical crisis, stress testing our regulatory frameworks in real time, retail brokerage giants opening the floodgates to direct crypto access, payment rails expanding to millions of merchants with open questions about who is actually being served, and a global race for regulatory clarity that the United States is competing in, but not yet dominating. And that is exactly why the conversation you're about to hear matters so much. I sat down with SEC Commissioner Hester Peirce, and I want to tell you the commissioner and I have been in conversation for years now. She was one of the first people at the regulatory level who was accessible, transparent, and consistent in engaging with me, with my students, and those who are exploring this space from both an academic, legal, and policy side. And in this conversation, we go deep. She talks about what it took to move the SEC from enforcement first to actual rulemaking under Chairman Atkins. She walks through the 5-part token taxonomy and how confident she is those categories will actually hold up over time. We briefly explain the 2% haircut framework, a staff level change that she says makes it commercially feasible for broker dealers to participate in this space. She makes the case for regulatory sandboxes and cross border experimentation. And she responds directly to the criticism that the pendulum has swung too far toward deregulation. And her answer reframes the entire debate around investor protection. And finally, she shares advice for law students and even mid career attorneys that I wish I'd heard when I first started down this path. Commissioner Peirce is exactly who you want explaining this moment. So enjoy and let's get into it. Welcome back, everyone, to Confidently Crypto. As promised, I have the great pleasure to reconnect with Commissioner Hester Peirce from the SEC. We've run down all of her bona fides, but I wanted to just leave a lot of space for engagement and to just talk about the state of where the direction of enforcement is, kind of the lead up to where we are in the crypto space. And in particular, I've been so drawn over the years to Commissioner Peirce and her very thoughtful um, writings on various topics. And also, Commissioner, your accessibility and transparency has been, I mean, you've just been so consistent throughout my time of interacting. We connected early in my exploration, just after I hit my head somewhere at the bottom of the rabbit hole, as you know, a tech adjacent person and an academic, just really focused on personally not knowing what cryptographically secured assets or distributed ledgers, what all of that would mean to me personally in 2017. But I'd come across this academic paper at the intersection of my expertise, which is in intellectual property and new technologies. And this was the new kid on the block at the time. And no matter my personal opinion, I wanted to make sure that I was sufficiently well versed so that the next wave of law students and new lawyers and those who are repositioning themselves could be um, um, well prepared, and so that the next wave of legal practitioners would be conversant in this space. And so even before we kind of get into the state of cryptocurrency regulation, your role, some of your recent writings about the 2% haircut, all of that, just at a fundamental level, I always think it's quite interesting that people hear how, and I get this question all the time, so I'm interested in how you feel about it. How did someone like you get into something like this, whatever that this means for folks? So kind of talk to us about what led you to the work that you do now.
Well, thank you, Dr. Evans. It's great to be with you, and I really enjoy the fact that we've talked now over so many years. I just remember you being one of the first people who were thinking about this in the legal academic world, and you were doing virtual class long before the pandemic. You had established that routine, and so I just appreciate that you've stayed focused and interested in these issues, and that we've been able to stay connected on them as well. I do want to start with my disclaimer, of course, which is that my views are my own views as a commissioner, not necessarily those of the SEC or my fellow commissioners. I really got pulled into this whole area by the fact that the SEC, when I started as a commissioner in 2018, was really being confronted by how crypto and the markets we were used to regulating were starting to intersect with one another. And I knew from my time being at the commission before that we sometimes don't know what to do with innovation. As as regulators, it's understandably difficult. And with something like crypto, the response of the regulator can be, let's just hope this is a passing fad and we don't really have to deal with it. I could see from the outside before I got to the commission that it was going to be something that we would have to deal with. And so that sort of got me started on I had certainly heard of Bitcoin well before I got to the SEC, and I thought it was interesting because it does enable people to transfer value over the internet in the same way that they used to be able to transfer data. And I think that the idea of that is quite interesting and powerful. So that had already been something that I was following, but I realized that it was going to be something I had to really understand a little bit more about. So now I've been on a journey over the time as commissioner to really learn more about the technology, to learn more about what this means for SEC regulated markets, and then in the past year with the crypto formation of the crypto task force, it's become an even bigger part of what I think about on a daily basis.
It was fascinating to see the development of the crypto task force and to see the dramatic shift in regulatory focus. Um, and what I'm about to ask is kind of the ramp up to the discussions between the SEC and CFTC. And for those who don't really have the history, I've talked quite a bit in previous episodes about the status before 2025, all of the things both on the legislative side and on the regulatory front to move forward and to take a decided uh, shift in the approach to the classification of digital assets. One of the things that was most concerning to me for so many years was the absence of a classification or a taxonomy that numerous agencies could agree upon. And what we've seen, excuse me, out of the conversations, not necessarily the conversations, but some of the public information and discussions around the importance of classification in order to have a brighter, I don't know if it's bright, but a brighter line that distinguishes between something that might be an investment contract and therefore rise to the level of securities under the auspices of the SEC versus the underlying asset that in and of itself, if we were comparing, a cryptocurrency more broadly to an orange, and you know why I'm saying that. Can you talk about the importance of being clear for an entire body of regulated parties to at least be using the same terminology to make it easier for regulated parties to know and for agencies to know this is my purview, this is perhaps another agency?
Yeah, I think it's important that you put that point in about how regulators also need to know because we have limited resources always,
Mhm.
and so we're trying to figure out where we should spend those resources. And if we are, casting about and trying to grab as much jurisdiction as possible, it does prevent us from doing things within our clear jurisdiction that we should be doing. And so part of the benefit of providing a taxonomy, which we did recently when we put out an interpretive release, part of the advantage there is it helps us to focus our attention. It helps the Commodity Futures Trading Commission to focus their attention. It helps Congress as they're working on legislation to figure out where there might be gaps in regulation and where they might want to fill those gaps, or maybe not. But at least it puts that issue in front of them. And then what we had really observed over the years was that people were consistently coming to us and saying, I just don't understand what the limits are, how you're thinking about these things. Statements are coming out of the SEC that most crypto assets are securities. What does that even mean? Because it doesn't really seem to line up with reality.
Mm.
And so I think trying to take a step back and say let's put these things in buckets. Facts and circumstances always matter, of course, but we can put these things in buckets, and then we can focus on the fact that some of these commodities are being sold. They're digital commodities, but they're being sold as part of together with an investment contract.
Right.
And so, what does that mean for someone who's then buying that on a secondary market, for example? And so, really trying to provide some thinking around that to help people understand how the agency is thinking about it. And then that will enable us to figure out where we need to maybe give people regulatory pathways to do things to raise capital using crypto assets, to figure out when the investment contract is no longer attached to the underlying token, to figure out where these things can trade. We can tackle that, but having the taxonomy as the basis is really helpful.
And for listeners and ultimately viewers, we're talking about five basic categories or buckets: digital commodities, securities, collectibles, uh, tools. So that suggests utility and certainly stable coins. I'm wondering, kind of as a quick follow up, how confident are you? And there's a method to the madness of my conversation because I'm thinking of a conversation I had in class recently, challenging students, law students, to think through how confident they would be that these categories would hold up as the technology evolves. Intimated to a response to that by the latter part of your answer. But how do you feel about how these things hold up and what to do for those edge cases?
I do think they're pretty broad categories, and so I think they should hold up pretty well over time. But of course, we welcome feedback, and if people think we've missed it or gotten it wrong, or if they think that we're constraining the growth of the industry, which sometimes something like a taxonomy can do. It can constrain it or direct it in a direction that it
Mhm.
otherwise wouldn't have gone. I mean, that's something that I worry about. So, people should provide us feedback, but I think of them as generally, you know, so broad that they should be able to hold up. But the edge case question is a good one. And so I think we wanted to give lawyers something that they could hang their hat on. It has been very difficult for lawyers in this space because they don't know what to point to. The commission staff had put out guidance in the past that was really hard for people to figure out how to follow.
Mhm.
So I think this will give people a little bit more certainty. And then, come talk to us if you're seeing edge cases. uh, we we're happy to work through we don't give legal advice, but we're happy to work through unique considerations as things change. I mean, I expect what we'll see is that you may end up with more tokens that are securities because people
Mm.
decide that actually they would like to create a security so that they can give rights to the owners that they wouldn't be able to do if they were not securities.
Mhm.
But the taxonomy contemplates that, um, and our existing rules largely are agnostic to what form a security takes. And
Mhm.
so I think we can work with people on those as well.
You That reminds me of you know I think of some of your writings and commentary around sandboxes. I've always been a fan. I think we have the industry, I should say, has greater latitude to explore things of that nature. I've done some work and research around, for example, other countries, most notably now Ghana, and trying to work through what that looks like. There have been states that are exploring here in the United States what a sandbox might look like. Talk about the benefits of to regulators, quite frankly. We always assume that there'll be some benefit to industry participants who have uh, a safe environment to de-risk at least the liability, the regulatory liability when they're operating in a vacuum. I also have seen the benefits or have heard the benefits to regulators who get more information. So that kind of dovetails off of what you just said. Could you share some of those thoughts around sandboxes and the benefits to regulators?
Yeah, the primary benefit I think is to market participants so they can figure out whether there's a market for
Yeah.
something and they can try things. In fact, we just heard from some folks who said it would really be nice if the U.S. allowed more experimentation because there's some things that you really can't figure out whether they'll work,
Right.
and what the flaws are unless you're doing some kind of experiment. And if you tell people no, the only way you can do it is to go full blown registration, then they spend a lot of money and they put something out there, and then it might have flaws in it that are really bad for investors. But I agree with you that as regulators, it is in our benefit to be able to see things happen at a smaller scale first, and then we can learn lessons about how it might be appropriate to regulate this if it's going to continue and gain traction in the market. And I've talked, for example, about working with foreign regulators to see if we can do some cross-border work as well,
Mm,
because then we'll have the opportunity to learn with our regulatory counterparts about how this is working, are there differences in the jurisdiction about how it works, and might that be a function of some regulatory differences between the jurisdictions. So I think we can certainly learn, and I've been grateful that there are people who are willing to come in and tell us they want to try something and get no action, a no action letter,
mhm.
or get some sort of exemptive relief so that they can do things, and then we can figure out longer term how to write rules. The example that I often give is exchange traded funds, which are now prevalent, right? They
Right.
started out as an experiment, and they were we gave exemptions um, to fund sponsors that wanted to launch exchange traded funds, and then we conditioned that relief, that exemptive relief, and we learned over time what conditions were important. And then eventually, and I think we took too long to get to it, but eventually we did write a rule
Mm.
so that everyone could just rely on that rule without coming in for specific exemptive relief. And we clearly learned from the experience that we had had over the years with those sandbox type experiments.
Yeah, it's an excellent point, and to see the prevalence of exchange traded funds now, not only in the traditional market, but as we saw ETFs for Bitcoin and ETH come through as well. It is fascinating because now that's the best example, not only in traditional markets, but the exploration of other underlying assets as well. Uh, Switching over, because the one of the things that I tell students and also in the consulting world is one of the best ways to keep up with what's going on with regulators is subscribing directly to their announcements. And I spend quite a bit of my mornings or afternoons, or sometimes burning the midnight oil, catching up on various announcements. And one that caught my eye recently was about this 2% haircut, and not being a securities lawyer, but being very interested in some of the reasons or rationales where a company or bank might be hesitant or reticent to move into the space because of um, technical parameters that don't make it in their best interest. And then you had recently made some statements, or maybe it was just a written statement around those changes. So I wrote about that, covered it in class. For those listeners or viewers who aren't securities lawyer, can you talk about what that guidance around the quote unquote 2% haircut framework actually means for firms who or that want to custody crypto, and why it matters? It caught my eyes, like, I know securities lawyer, but this seems like a very big deal to me. And I didn't see as many people writing about it as I thought should. I think it's a hugely important change.
Yeah, and it was a staff document, but I think, and it really pertained to stable coins, and to say, look, we're looking at them much as we would look at money market funds. And so that's the haircut we would use for money market funds for broker dealers. And so we should use a similar haircut for stable coins. And so it is a technical change, but it's one that I think contributes to it being commercially feasible for
Understood.
brokers to participate in this area.
The uh, there's been so much conversation around the move forward with stablecoins because over in the legislative branch, we see, saw as of July of 2025, signing in of the Genius Act into law with some very clear legislative parameters around stablecoins in particular. I know not all jurisdictions move forward to kind of separate things out, and you are in the executive branch, not over the legislative branch. But it's been quite fascinating also as a professor who taught administrative law to see how important administrative law is to understanding the entirety of this relationship. The lead up, I think of my old teaching package of certainly intellectual property. I taught first year property for 10 years. I taught wills, trust, and estates. I taught administrative law, a little entertainment law, uh, and business law. And it all came full swing into one place that is what I lovingly call blockchain cryptocurrency in law. This balance, I bring it up and kind of set it up this way because can you impress upon the audience about the way that the legislative framework really is just that, a framework, and the importance of subject matter experts in the executive branch and various agencies to actually move forward with the framework, but kind of be the mortar, if I were to use a brick and mortar type of analogy, that connection to administrative law is so critically important to understand how something that happens legislatively has an impact. And the final point to that is kind of unless and until Congress says something different, we are focused on the subject matter experts with the task at hand, having some legislative power to make rules, to go forward with enforcement. But they're distinct, but integral. Probably is the best way to say it.
Yeah, I mean, I always look at the legislation as the skeleton, and then the regulators are putting the flesh on the meat on the bones of that skeleton. And I think you don't really get a sense of what something will look like until you see what the regulators have done. Now, I think recent administrative law cases make it very clear that
Mm.
we need to hew very closely to what Congress told us to do. And that's something that I've always believed is important, especially after spending time as a staffer on the Senate Banking Committee and seeing how, you really want the regulators to follow the instructions that Congress has given them. That's how the system works best. And if the regulators think something needs to change, they can certainly go to Congress and explain why a change, what effect a change could have, for example. But I think you're right that it's this is an area that brings together many different strands of law, and understanding the administrative framework is helpful, and also understanding that there are a bunch of different agencies that are involved here, and each one has a slightly different flavor in terms of the approaches they take and how they do things. So you have a big job in trying to learn not only administrative law writ large, but also as it applies at different agencies.
When that brings me back to another point of in my personal opinion, the importance of agencies cross collaborating as much as possible. If I recall, you have made statements, I don't want to put words in your mouth, but the ability to collaborate across agencies just makes the landscape better for everyone, not only certainly for the regulated parties, but also so that there's clear understanding that we're moving with one voice, even though there are distinct aspects where, for example, the SEC has a role in a very specific call. The CFTC, you think about Treasury, FinCEN, you think of prudential regulators and the like, IRS. Every one of those agencies has its own focus and its mandate, and yet the collaboration is critically important. To talk to me from your point of view, the imports of that, and even how something like that comes to be. What goes on kind of in the background for in terms of those discussions?
I think now the real emphasis has been on looking at it from the perspective of the American public. And they don't
Mm,
look at it like, what's the SEC's responsibility? What's the CFTC's responsibility? And they just say the government should be doing its job and they ought to figure out who's best able to do it, meaning that it is within the legislative remit of that agency, and the agency also has the tools to do it. And so too much of the SEC's history has been marked by conflicts with, for example, the Commodity Futures Trading Commission, because it is unusual to have two different agencies. In many jurisdictions, you have one agency responsible for both the capital markets and the risk mitigation markets, which are the CFTC markets. And so there are going to be areas where our jurisdiction is hazy, where there are things. Current chairman of the SEC often talks about this sort of gray zone or no man's land where
mhm,
you get products and because no one can figure out who's responsible, they just don't come to the market. And that's exactly not what we want to have happen. So there's an effort on the part of the SEC and the CFTC now to work together in a much more deliberate manner and build some patterns and practices where we can address very early in the life of a product, or as
mm,
people are conceiving a product, that they'll be able to come to us and figure out where it sits. And there may be times when both of us have a legitimate regulatory claim to something, but we can sit down together and say, okay, this, you can handle this other agency. Just let's make sure there's information sharing and let's make sure that we can have the view of that market and that product that we need to have in order to do our jobs
mhm,
with respect to other products. So I think um, watching it play out in a better way now between these two agencies is helpful. And of course, there are broader efforts to collaborate across all the financial regulators in the U.S. And then there are also efforts to work with our international counterparts.
mhm. And we've spoken quite a bit about um, industry and the impact to industry with kind of the change in the policy and enforcement approach. Part of my task and my commitment for Confident with Crypto and all of my education is also thinking about just the everyday person who maybe has some crypto, becomes interested in stable coins, or all of a sudden their advisor is now talking about spot market ETFs, and they're like, "What?" Right? What does all of this greater regulatory clarity, in my humble estimation, and this change, uh, based upon kind of the administrative changes that have trickled down in terms of policy, what does that actually change for the average person? Maybe separate and apart from industry, because it certainly has an impact.
No, I think the effect on the everyday person is what matters the most. And the first thing that I take from the current approach is that we're trying to get to a world where lines are clear so that someone who's buying one of these assets understands whether she's getting the protection of the securities laws or not.
Mm,
That may make a difference to whether she wants to buy a particular asset. And so I want it to be clear enough for her to understand that. And then the second piece is when you have agencies that are unclear about their jurisdiction and they're sort of randomly bringing enforcement cases, um, but they're not consistently um, setting out a regulatory framework and then consistently enforcing that, it actually is really impairs the ability of the regulator to police. I don't know that that's the right term, but to surveil and uphold standards in that market. And so getting clear lines in place will help us figure out where our enforcement resources can best be used, will help us figure out when we may not have enforcement authority, and maybe we can refer it to another regulator or another government agency at the federal or state level who can enforce that.
mhm,
And so I think it will lead to better protection for investors. And then another element is that as we get clarity around what these products are, we will be able to do a better job of tailoring disclosure regimes, or facilitating the tailoring of disclosure regimes by people offering these products, so that the people buying them will actually be able to understand what they're buying. And some of that can be done by private sector best practices. It doesn't have to be a government regulation, but certainly the lack of clarity around where products fit in the regulatory structure, I think, inhibited the growth of healthy disclosure practices. And another thing that I think inhibited the development of good disclosure practices is just this idea that the less you said, the less likely you were to find yourself at the other end of an enforcement action. And so you might end up, if you're a bad actor, you're less likely to face regulatory action than if you're a good actor. And that doesn't make sense. That's completely topsy turvy. And so trying to get back to a world in which we actually reward people who are willing to make disclosures. Um, and so I think that that is all going to be much better for the end retail investor or purchaser of crypto assets.
I feel like there's some who will listen or watch and say, "This is news to me that the SEC is interested in regulation and enforcement," because the headlines I read say that it's total deregulation by default, the absence of enforcement, the pendulum has swung too far in the opposite direction. I'm wondering, do you think that is accurate, and do you think that's fair?
No, I think it's a misunderstanding of what happened. So what was happening in recent years was there was a real effort to use the enforcement tool, to sort of shape, in a very rough way, to shape the regulatory framework. And that is just a terrible way of writing rules, because what you have is you have an entity that the agency has sued or is threatening to sue. And you have the agency, and you have the two of them sitting in a back room together negotiating over a potential regulatory structure. Those negotiations are not happening in the context of notice and comment rulemaking. They're not happening in the context where you have a lot of different voices of investors, uh, industry people, academics, any other interested parties. You're in this two-party situation where the leverage is very much on the side of the government because it's about to sue or it is suing you. And so it creates this very weird regulatory framework. And so when we came in, we looked at the situation, we said, the SEC has been using the wrong tool. I mean, and it's not, I've been saying this for a long time, so it shouldn't have been a surprise to anyone that I would say, hey, I want to try to write some rules first and then enforce them later. But the second piece of that really is that there is a lot of bad activity that is either happening in crypto or in the name of crypto.
Mm,
And we need to get those rules on the books so that we can really spend our time and our resources enforcing um, against those bad actors. And again, it may not be that all of the bad activity is in the SEC's purview, but that we will be better able to identify where the authority might be to go after some of those bad actors. And it will be easier for individuals to identify the legitimate actors. That's my hope when you have a regulatory framework in place than it was before. I think all of us care tremendously about upholding the standards in our marketplace and making sure that the US markets remain the place where people want to go because they know they'll be able to get products and services that they can rely. We're not a merit regulator, so we're not telling you whether the product or service is good, but
mm.
if they're getting a disclosure, they can rely on that disclosure. And if someone's lying, that there's some ability for the government to go after that person, or if there's manipulation of the markets, that there is a framework in place to go after that bad activity as well.
It's fascinating, and thank you for that. I think that's very helpful. As we close out, I always want to circle back to our esteemed colleagues in the law and our soon lawyers to be, to think about, as you said, I've been working at this for a long time, but first started that online certificate program back in 2018 to focus on what in the curriculum in law school, and as either not just even new lawyers, but lawyers like me, kind of mid-career, looking to um, remain relevant, remain competent, and to really be uh, on the leading edge of helping clients through. Uh, Oftentimes, people describe this as building the plane while flying it. There's some things that we know, many things we don't. So a lot of really important lawyering happens to support clients to do the very work that you're talking about. When they have to engage with regulators, or when they have to speak to someone who comes in for a business or a wills, trust, and estates issue, but happens to mention that it touches either tangentially or primarily this novel asset class. And so thinking about, first, for law students, knowing what you know now, what are the key areas and disciplines that can help them be informed about the work uh, in the area of cryptocurrencies? I know it's so broad; it literally is touching every industry and sector in some form or fashion. But particularly from a security standpoint, and as an attorney, if you're a law student at this time, what would be some of the things that you would think about and take in order to make your job today much easier?
I mean, I always recommend people take securities law because I think it actually does touch so many different areas apart from the crypto aspect. Just more generally, it's good to learn securities law. And I think the advice I would give is become the best lawyer you can become. Don't set out to become a crypto lawyer, become the best lawyer, and then you can you can layer in knowledge of crypto, so you can learn the technology, you can learn some of the issues. But if you don't have that solid base, you're going to run into trouble. And I think also, you didn't ask me this yet, but for the mid-career folks,
Yes.
you may feel at a disadvantage because the technology is new, but the base level of experience and knowledge that you have is so important for us to put these crypto issues in context. And I think one of the most fascinating pieces or aspects of crypto issues is that they really do touch on so many different areas, as you said. And so it can be a really interesting lens through which to look at a whole range of securities law issues, from broker dealer regulation to clearing agencies to exchanges to investment companies to corporation finance disclosure issues. So you really need to be honest with yourself and with your clients about whether or not you have the base knowledge on which you can then layer the crypto knowledge. And there's going to be a day when there'll be fewer crypto lawyers and there'll be more lawyers who are specialists in a particular area. And they, of course, will be integrating the crypto aspects into their daily practice.
I think it's just such a fascinating area. I'm completely and totally biased because the way that I've transformed my own career, my relationship to the intersection of finance and technology, has been nothing short of amazing. The way that it has touched on all of my areas of expertise, and what I offer to our colleagues is just to begin at the intersection of your existing area of expertise. And we're in a post-information age. There's no shortage of information. Start to curate that information in a way that makes sense for you and your practice and where you are now. And working with your colleagues to at least be conversant in the space. So, to the commissioner's point, being able to issue spot and problem solve, at the end of the day, that's what we do. And so to put yourself in a position to do that as a matter of competence from a professional responsibility point of view, and part of competence also focuses on technological competence. And I believe the commissioner would agree with me when I say it's more than turning on the laptop, that we have to understand the impact of new technologies on what matters most for our clients and ultimately for citizens. So, Commissioner Peirce, I thank you so much for always being so gracious with your time and keeping us on our toes so that we are always thinking about what are the important issues of today that actually transform how technology and markets and those who engage with them, both in the individual capacity, but also at the corporate level, will have greater clarity to make more of a positive impact and to keep those positive impacts here in the United States as well.
Well, thank you, Dr. Evans. It's been a pleasure.